Let's look at France, because there's a very interesting and long-term pattern. First off, read this disclaimer carefully, and do your good deed of the day by liking and subscribing. So we go to stock chart. Well, before we look at stock charts, let's actually just get the data. So we do have France here. It's in Northern Europe, 5-ish move here from the low, but a minus 3% pullback here from the highs. So here is the big picture weekly data points, and the time cycles have been rather spectacular. So you can see that rise, decline, rise, decline, rise, decline, rise, decline, rise, decline. You see that it is rather accurate. Even this move here, rise and the decline, and then you have the current rising phase. So if you look at the previous rising phases, so here the gains come relatively quickly. So here we peak 2 times, but the initial peak is early in the rising phase. Here we are approaching the middle. Here we are approaching the middle, and this is where we are now. So the rising phases have been longer in the past. So during this super phase, where we had a super shallow declining phase here, in this instance we did see very extended PPO, which is the distance between price and the 200-week moving average. In this instance we are far below, but in these 3 time cycles we do see that the current PPO did mark the high in this time cycle and also in this time cycle. So that is a potential bearish sign. In terms of weekly RSI, during this rising phase, we were at a high RSI for an extended period. In this instance, we do have a high reading. During this smaller time cycle, you did see that high RSI was it forewarned the pullback. So RSI has kind of given us a bit of a mixed signals, in the sense that we have been able to have extended periods of high RSI in the past without it triggering a pullback. But there's been other times, like here and here especially, and also these 2 phases here, where high RSI did basically trigger the sell-off. So the signals are mixed, but basically high RSI at these levels, it is a risky situation for the bulls. When we compare the time cycle with the seasonality, the current time cycle. So we are currently in the last part of June. June tends to be a bit mediocre. July tends to be decent, so it closes higher 58% of the time. There's usually around 0.8% gain. Not huge. August tends to be weak, so we are in a mediocre period. So the June to August period tends to be lackluster. So there could be more left in the rally, but we are certainly towards the late part of the rising phase, based on the history of this ETF, and the time cycles have been very consistent for a long time. Looking decades into the past, we do see that the time cycles have given us good signals to get in and out, and there is risk here for the bulls for sure. When we look at how far this time cycle rose above this one, it was 7.5-ish%. Here, this versus this one, 7.6-ish%. So these 2 time cycles, the breakout, before the peak was formed, it was of very similar magnitude. And the current breakout from this high, we do have a 17% gain. How far are we away from a new all-time high? So let's measure. Approximately 3%. That in turn begs the question, is the current economic situation for France stronger than what we had before the global financial crisis? Because in order for us to really do have a breakout above these highs, that would have to be the case. I'm not sure of that, but there is, a lot of central bank stimulus, very easy monetary policies. So that is, of course, a catalyst. But we do have some readings that show that, we are at the very late part of the rally. And as far as drawing lessons from buying low and selling high, if you were to buy here, so from here to here is a 54% move. But from that level to the recent high, that is just quote unquote, 32-ish percent. So the value investor who bought low here and exited too early would beat the momentum investor that waited for a breakout above the red 200 week moving average, as an example. So it's something to think about, because it's always about the percentage moves in your account. Okay, so looking here at the daily data points, so the PPO, we do have a high reading, an extended high reading, frankly, here versus the 200-day moving average in this case. In this instance, we did initially peak, correct to the 50-day moving average. Then we did the rise higher, but then we did have, a significant correction. In this instance, we test, the red 200-day moving average multiple times. So during this phase, we frequently test. During this phase, we do test. Then we do breakdown. In this instance, it's been a protracted period without us testing the blue 100 or the red 200-day moving average, which, if you look at it historically, it's an anomaly. So in this instance, frequent testing here. We go further back, very frequent testing here as well. So the current rally is, objectively speaking, euphoric compared to the previous. So that's just a reality of the situation. So here is Finviz. They do draw this trend line, which has been decent, to use as a signal, but we don't get much. When we compare France with the S&P 500, which is America, we do see actually that France does have a significantly higher price earnings. So S&P America is minus 17% below France. So that is so definitively there's been a lot of love for France. So you can't make any kind of value case. I mean America is objectively cheaper. Looking at the dividend, it's also higher for America. So that is also a bit of a bearish point. Here we can see the top holdings in France. A bunch of famous names. So consumer non-durables is on the top. And that is discretionary, more economically sensitive, like Louis Vuitton. That is very sensitive to the economy. L'Oreal, Hermes International, definitively, they are in the very much luxury products. And these are the kind of industries that do well during economic booms, but they are the first things you will save money on. You do not, objectively speaking, need a Louis Vuitton purse. You just don't need it. So there are cheaper alternatives to L'Oreal. So that's something to think about in terms of where we are in the economic cycle, and also in the the economic psychology of investors and consumers, of course. So yeah, taking it all together, at this point, the bulls are still doing something. If we go here to the daily data points, we are testing here, the green 50-day moving average. Here we test rally. Now we are testing it a bit vigorously, so the bears are being more reluctant here. You see that they are holding back the bulls in ways they haven't done in quite some time. So that is interesting from a more bearish perspective. Because you see here, the bulls try, bears come back fast. Here, bulls try, bears come back fast. And the more time you test, support level, the higher the probability that it is going to break. So yeah, looking longer term, I think, especially based on the time cycles, it definitively makes sense to start to consider bearish strategies here for France. That is just, what the data suggests.